Conditions are changing quickly in the Raleigh housing market for buyers and sellers as the Fed fights to tame inflation, and leading and lagging indicators are both signaling a recession. Hey, I'm Wofford, real estate broker with Berkshire Hathaway in Raleigh, North Carolina. And on today's video, I'll update you on what's going on in the Raleigh market so you can make the most of this situation. To start off, the Fed's decision to raise interest rates has sent about 20% of the buyers to the sidelines, which means the odds of selling a home for multiple offers has decreased to less than 50%. And the best way to describe it is homes in the $500,000 to $750,000 price point, well, they're now seeing an average about 6 to 8 showings per month. Compare that to about 20 or so average showings in the February-March period of this year when the market was red hot and I was writing offers for buyers before they actually even set foot in the house. And sometimes that was too late. But of course, that meant buyers had to take on extraordinary levels of risk and pretty much pray nothing was seriously wrong with the home. Because in North Carolina, to win an offer at that point in time, you had to entice sellers with obscene amounts of due diligence, which is also referred to as non-refundable deposit money, just to have a chance. And if that wasn't enough risk, buyers had to make up the difference to cover the appraisal gap if the appraisal came in low. So if, for example, they needed 5 or 10% down to get their loan funded, it meant they had to come up with the extra money. But those risks, they weren't even putting a dent in the demand for loans. And honestly, I've never seen a market that was more lopsided in favor of sellers. But today, while we're still in a seller's market, conditions are more favorable for buyers as a majority of sellers are glad to get an offer, and they're much less likely to hold or shop your offer for a better offer. So if you're a buyer, it means you can likely negotiate a much more favorable deal right now. Now, I realize rates have risen substantially from a low of around 2.66%. But let's face it, that was probably a once-in-a-lifetime scenario, and that's probably not going to happen again anytime soon. And I'm sure a lot of you are thinking, with the Fed raising the benchmark rate another 75 basis points again on Wednesday, shouldn't that be driving mortgage rates up even more? Well, not exactly. You see, the Fed funds rate is simply the rate at which commercial banks borrow and lend their excess reserves to each other overnight. So the Fed funds rate doesn't actually influence mortgage rates. Banks typically set their mortgage rates based on the movement and direction of the 10-year Treasury note. So after yesterday's announcement, the stock market and the 10-year Treasury reacted favorably to the rate hike, which tells us the rate hike was expected and the mortgage market had already factored this in. So let me be clear. I'm not saying there aren't consequences to an increased Fed funds rate. I'm just saying the 10-year Treasury note and mortgage rates aren't directly correlated to the Fed's fund rate. Now, variable loan rates like credit cards, student loans, and HELOCs, they are directly tied to the Fed funds rate. So those types of credit instruments, well, they're going to be negatively affected. While savings accounts and checkings accounts, on the other hand, they're going to be positively affected. And mortgage rates vary considerably right now, with 30-year jumbo loans as low as 4.57%, and 30-year conventional loans really between 5 and 5.5%. And if you ask me, that's actually pretty reasonable if you look back at the 50-year history of the 30-year mortgage rate. Now, the Raleigh housing inventory is still at record low levels, and we currently have less than a 2-month supply of homes. And I want to point out about 37% of those homes are actually new construction homes. And Raleigh was second in the nation, just behind Austin, Texas, in terms of housing starts. So there's going to be much more carnage to come as builders complete homes that they started that are still currently under contract. And digging a little deeper into new construction, I want to point out that buyers of new construction homes typically don't have their interest rates locked because of the long build time and uncertainty of the closing day compared to the quick close time in the resale market, which means new construction buyers are basically at the mercy of the mortgage market. And when a lot of these new construction buyers went under contract for these new construction homes they pre-qualified, the purchases based on low mortgage rates. And so a large percentage of them aren't going to be able to qualify for the new payments, which means the builders and buyers, they're going to have to renegotiate the deal or they're going to lose their deposit and the builder is going to put the home back on the market. Now, I'm sure you're thinking, well, now the builder has the deposit money, so he or she's got to be better off. No, the price of those homes is actually falling as demand is reduced across the market. This can be seen in the weekly number of mortgage applications. As you can see, that number is a national number, but it's down 20% compared to the year ago. So the builder's actually better off to see if they can renegotiate a deal that both parties can actually manage. So again, as I mentioned, new construction represents 37% of the Raleigh housing supply. Another interesting point I'll make is since the housing market in Raleigh is about 49% investor-owned housing, I do see a lot of homes in locations that aren't as popular, and they're pretty much in horrible condition. So some of these homes were picked up by investors looking to make a quick profit on appreciation. And these homes only sold at inflated prices because mortgage rates were low. And as mortgage rates rise to a more normal level, I think these are going to be the properties that actually correct the most. And they would include Zillow and Open Door properties. And in fact, I've shown lots of these houses where the price was marked up significantly with no repairs, and a lot of them often needed significant repairs. But get this, they dramatically increased the list price with the majority of these investors owning the property less than 6 months. So it's not just a one-size-fits-all market. You have some really nice homes that are priced properly and have been well cared for. They're going to sell for above list. And on the other hand, you have lots of investor-owned properties that haven't been updated or taken care of that are overpriced. And these properties are going to be picked over and passed over by retail buyers. So as rates rise, I don't expect the owner-occupied resale market of high-quality housing to speed up, as a majority of the homeowners have built up a lot of equity in their homes, and they already have mortgages with low interest rates. So the majority of these sellers will be people that have a compelling reason to move if the price and buyer demand remains low. Now on the bright side, companies like Zillow and Open Door that once capitalized and built businesses around low rates and computer-based pricing models, well, they're going to have to scale back or exit the market, because as rates rise and investor and buyer demand wanes, the algorithms and the Zestimates, they're not going to work, because in today's market, real buyers are carefully considering the purchase of homes, and the details and condition matters now that the mortgage market's at a much more normal level. So the investor demand that previously crowded out a lot of buyers is drying up quickly as rates increase. But I do think, in general, most buyers, they're going to need to scale back their purchase price to adequately reflect the increase in mortgage rates. But remember, as fast as rates rise, they can fall once inflation's under control. And if your rent's going to be as much as your mortgage, well, you might as well be an owner, because having a fixed mortgage payment is one of the best ways you can reduce your exposure to inflation, since housing is likely your largest cost. Now, for sellers that really need to sell right now, your home really needs to be priced appropriately, and properties must check a lot of the must-have boxes for a typical buyer to make an offer quickly, or you run the risk of running up days on market. And sellers also have to realize that on average, it's going to take longer to sell a home today. So I do think the current mortgage rates bring us back to a more normal pre-pandemic level in the Raleigh market, where price, condition, square footage, and location really need to make sense for a home to move quickly with multiple offers that drive up the price of the home and the strength of the offer. So I think the biggest trends to watch for right now will be the inflation numbers, because if the Fed can get inflation under control, they're likely to stop raising rates, and the mortgage rates could fall as consumer and investor confidence comes back and stimulates demand. In fact, if you look at the disclaimer on the Fed's recent announcement, they said they'd be carefully monitoring the economy and may scale back, reduce, or remove further rate hikes if warranted. So this is good, and this means they're going to take a more data-driven approach. So I think we'll just have to see how it all plays out. But you have to realize it's the housing market that's going to be the first to fall when things get bad in the economy. But it's also going to be the first to recover as the economy begins to improve. So I think we'll have a much clearer sense of just how much buyer demand there really is with rates higher, which will give us a better sense of how many months of inventory we actually have in this new mortgage rate environment. So you'd need more than a 7-month supply of housing inventory for housing prices to really drop significantly in the Raleigh market on a large scale. And I will tell you, there are plenty of homes in highly desirable locations that are priced right. They're going under contract quickly with multiple offers from aggressive buyers that generate lots of showing. But by and large, as I mentioned, it's the homes in disrepair. They're getting picked over and passed over, which might actually be a good opportunity for you as a buyer to get out there and buy one if you don't mind hiring flooring contractors, painters, plumbers, and other related building contractors to make the repairs and upgrades. Of course, if the price and location of the home are ideal for you and makes sense. So what happens next? Well, honestly, I don't know if this is going to be a short-term trend or a long-term trend with interest rates, but I don't think it's going to be anything like the Great Recession of 2007 or 8, where there's basically a house of cards. I do know from a historical perspective, going back 50 years, the current mortgage rates, while significantly higher than the recent record low rates, are significantly better than 37 of the last 50 years. And with schools being out and families still on vacations, I think we'll have to wait until the fall to see if buyer demand returns to the Raleigh market. But I do think the massive year-over-year increases in home price will continue to slow to a much more normal level. And I don't think we'll give back much of the gains on homes that are priced right and in good condition. So if you're looking to buy a home right now, this might actually be a good time where you can get the home you want because there's substantially more homes available for sale with much less buyer competition. And in the long run, the market will correct itself and home prices should continue to rise. And I believe the Raleigh market will continue to be a very popular place to live. And I think it's entirely possible that we could end up like some of the larger cities out there where a significant percentage of our population can't actually afford to buy a house and ends up being a lifetime renter. So what I'm saying is, if you have the means to buy a home right now, might actually be a good time to do so, since buyer competition is significantly lower and sellers are willing to negotiate, which means buyers face much less risk in the transaction. As always, please reach out with a phone call, text, or email if you have any questions at all or would like some help finding a home in the Raleigh area, and I'll see you on the next one.